Throughout history, wealth has been transferred not through gradual, predictable changes, but through sudden shifts in the environment that force everyone to reassess what they value and what they trust. We are at such a moment now. For years, the thesis behind owning gold and silver was straightforward. Central banks were printing massive amounts of money, debts were compounding beyond sustainability, and currencies were being debased at a pace the world hadn't seen in generations. Precious metals in that environment served as insurance, a hedge against monetary irresponsibility and systemic fragility. But markets are not static. They evolve in cycles, and the very things that once protect you can at times become the source of risk. What we just witnessed in the past week marks a critical turning point. It's not simply about the price of gold or silver rising or falling. It's about a structural shift in how capital flows, how policy is set, and how confidence is managed. Throughout history, financial markets have moved in long cycles, periods where the same strategies that once provided safety or reward eventually stop working. What often catches investors off guard is that the turning point in these cycles is rarely obvious in the moment. It comes suddenly, concentrated in a narrow window of time when several forces that have been quietly building beneath the surface finally converge. These are the weeks that change everything. They force us to reassess assumptions, to reprice risk, and to recognize that the environment we are operating in is no longer the same as the one that validated our prior decisions. The past week represents one of those critical turning points. Gold and silver, which for years have served as reliable hedges against monetary expansion and political instability, now stand at a juncture where their protective role has been diminished by structural shifts in policy, economics, and psychology. This doesn't mean the metals are irrelevant. It means their role has changed. And recognizing that change is the essence of good decision-making. When I talk about a turning point, I mean more than just a price correction. Markets rise and fall daily, and those movements don't alter the fundamental rationale for owning an asset. What matters is when the environment, the set of drivers that made an asset attractive, undergoes a lasting transformation. The critical week we just experienced revealed precisely that, an inflection where the forces that once drove demand for gold and silver began to reverse. To understand this, think about why investors own metals in the first place. For much of the last decade, central banks were in a mode of extraordinary easing. Quantitative easing, near zero interest rates, liquidity injections. This environment punished savers and made non-yielding assets like gold and silver relatively more attractive. On top of that, geopolitical instability, trade disputes, and questions about the durability of fiat currencies added fuel to the demand for hard money. Metals were not just commodities. They were insurance against policy failure and systemic breakdown. But cycles don't last forever. This past week marked a shift in several key dynamics that underpin the metals trade. Central banks signaled a firmer commitment to fighting inflation through tighter monetary policy. Liquidity, which had been abundant, is now being withdrawn. Real interest rates, suppressed for years, are rising. And as those rates climb, the relative opportunity cost of holding metals becomes undeniable. When you can earn positive real returns in safer, income-generating assets, the rationale for storing wealth in instruments that provide no yield begins to erode. At the same time, geopolitical tensions, while still present, have lost their power to shock the markets in the same way they once did. Investors have adapted to ongoing instability, and the fear premium that was embedded in gold and silver prices has started to fade. What once triggered capital flows into metals is now met with a shrug as capital seeks growth and income elsewhere. Perhaps the most important element of this turning point is psychological. Markets move on stories as much as they do on fundamentals. For years, the dominant narrative was that metals were the ultimate hedge, the safe place to be in a world gone mad. But narratives are fragile. Once enough participants begin to question the story, the shift in sentiment cascades quickly. Selling begets more selling, and what was once considered safe suddenly feels like a liability. This past week, the cracks in the narrative became visible, and that alone changes behavior across the system. This is why I call it a critical turning point. Not because gold and silver are finished, not because they no longer serve a purpose, but because the balance of forces has changed in a way that demands adaptation. Investors who fail to recognize these shifts are often left holding positions that no longer align with the reality of the environment. Those who see the inflection early, however, can reposition themselves, taking profits, reducing exposure, and reallocating to assets more aligned with the emerging cycle. The big lesson here is that markets don't send polite notices when it's time to change course. They give us small signals, then a sudden moment of clarity. That moment has arrived for gold and silver. The week that just passed was not simply another swing in prices. It was the week that revealed the environment has shifted. And when the environment changes, strategies must change with it. When you study markets across centuries, you see a recurring pattern. Policy is always the most powerful driver. The decisions made by central banks and governments create the framework in which all other economic activity takes place. They control the supply of money and credit, and by extension, they influence growth, inflation, and the value of every asset. That's why understanding the policy shift we are experiencing now is critical to understanding why the environment for gold and silver has changed so dramatically. For more than a decade, central banks conditioned us to believe that easy money was permanent. Whenever growth slowed, they injected liquidity. Whenever markets stumbled, they cut rates further. Trillions of dollars were created, and the natural consequence was that real interest rates, the returns you earn after adjusting for inflation, fell deeply negative. In that world, holding gold and silver made sense. If your cash was being eroded by inflation and your bonds offered no real return, the opportunity cost of holding metals was effectively zero. Precious metals thrived because policy created an environment where their lack of yield didn't matter. But policy environments never stand still. What happened in the past week was not a random shift in tone, but a clear signal of direction. Central banks are stepping into a tightening phase, and the message is unambiguous. Inflation control now takes precedence over market accommodation. That pivot transforms the investment landscape. Here's why it matters. When central banks raise interest rates, they change the relative attractiveness of assets. Suddenly, government bonds that were unattractive for years begin to offer real returns. Cash, which was previously a melting ice cube, starts to look more appealing when short-term yields rise. As a result, the comparative advantage that gold and silver held during the easy money era diminishes. Investors are rational. They reallocate capital toward assets that generate income when policy rewards them for doing so. This shift also impacts liquidity. For years, the system was flooded with cheap money. Investors could borrow at near zero rates and speculate across markets. That flood lifted all boats, including gold and silver. But when liquidity is drained, the opposite occurs. Risk assets face selling pressure, and even traditional hedges lose their shine as investors reduce exposure broadly to raise cash. The tightening of money supply is like oxygen being removed from a fire. The flames don't go out instantly, but they begin to weaken. Another critical element is credibility. Central banks spent years convincing the world that inflation was transitory. That credibility was lost as prices spiraled higher. To restore it, policymakers now have to be seen as serious inflation fighters. That means pushing rates higher than markets may expect, even at the cost of slower growth. In such an environment, gold and silver lose their policy tailwind. The bet that central banks would always bail out markets no longer holds in the same way. The safety net is being pulled back, and metals are caught in that adjustment. It's important to emphasize that this is not about the absolute price level of rates. It's about direction and perception. Even modest increases in real rates have an outsized impact on gold and silver because their entire rationale depends on the absence of yield elsewhere. If investors can suddenly earn a positive, safe return in cash or bonds, then the case for holding large allocations to metals weakens significantly. The repricing doesn't need to be extreme to trigger large shifts in flows. This is what makes policy changes so powerful. They reshape the incentive structure of the entire system. Investors don't move based on what they wish were true. They move based on what is rewarded. And right now, central banks are rewarding patience, cash, and yield-bearing assets while penalizing those who cling to the old assumption that free money would last forever. The danger for investors is inertia. It's natural to assume that what worked yesterday will work tomorrow. But ignoring the policy cycle is one of the most expensive mistakes you can make. Gold and silver were the beneficiaries of one policy era, but they are now facing headwinds in the new one. The critical week that just unfolded revealed that shift more clearly than ever. To succeed, one must not fight the cycle but adapt to it. That means recognizing that central bank tightening is not just a background noise, it is the dominant force shaping every asset class. For gold and silver, the implication is clear. The easy money era that elevated them has ended, and until policy turns again, their role must be redefined within a portfolio. When you think about what drives demand for gold and silver beyond the economic cycle, one of the most enduring factors has been geopolitics. Human history is filled with conflict, instability, and uncertainty. Whenever wars erupt, alliances fracture, or global trade routes are threatened, people instinctively seek safety. Precious metals have traditionally played that role because they exist outside of the political system. They are tangible, scarce, and immune to the whims of policymakers. In times of chaos, they are the anchor that investors run to when trust in paper assets erodes. For years, the metals market was buoyed by this dynamic. From tensions in the Middle East to trade disputes between major powers to the risks of energy supply disruptions, each flare-up added a premium to the price of gold and silver. Investors didn't just see them as commodities, they saw them as insurance policies against the unknown. That geopolitical hedge often justified holding large positions, even when fundamentals or opportunity costs might have suggested otherwise. The narrative was simple: the world is unstable, therefore gold and silver must be owned. But here is the paradox. Over time, markets adapt to instability. What once seemed shocking becomes normalized. The fear premium that metals thrive on is not permanent. It fades as participants learn to live with the uncertainty. We are now seeing this unfold. The conflicts and tensions that once commanded headlines and triggered massive flows into gold and silver are still present, but their market impact has diminished. Investors are no longer reacting with the same urgency. Instead, they are allocating toward assets tied to growth, technology, and yield, reflecting a belief that instability is a background condition rather than a frontline threat. This is an important shift because it removes one of the key supports for metals. The assumption that geopolitical risk would always sustain their prices is being tested, and it reveals something fundamental about how markets process uncertainty. Fear has diminishing returns. The first shock has a big impact, but subsequent shocks matter less, unless they escalate dramatically or in unexpected ways. After a while, the insurance trade becomes overcrowded, and once people stop believing they need it, capital flows out. Consider the past week as an example. Tensions remain high in several regions, yet instead of rushing to gold and silver, investors have been reallocating into assets with yield and growth potential. The very events that would have once fueled a surge in metals are now being treated as noise. That change in behavior is profound. It tells us that the fear premium has eroded and that the geopolitical narrative supporting metals is losing traction. What does this mean in practical terms? It means the marginal buyer, the one who pushes prices higher, is no longer showing up in the same way without that marginal demand. Gold and silver become more exposed to other forces like monetary policy and real interest rates. The geopolitical hedge, which once offset those headwinds, is weakening. The balance has shifted. This also underscores the importance of distinguishing between perception and reality. The reality is that the world remains unstable and risks are ever present, but the perception is what drives markets. And the perception today is that instability has been priced in, managed, or absorbed. Investors are acting as if the risks are tolerable, and perception always outweighs reality in the short term. That divergence is critical. It is tempting to believe that because gold and silver have always benefited from global tensions, they always will. But history shows us that the relationship is cyclical. During some periods, geopolitical stress dominates investor psychology. During others, it is overshadowed by monetary and economic considerations. We are in one of those latter periods now, where policy and yields matter more than conflict. The lesson here is not that geopolitics no longer matter. They always matter, but that their market impact is fluid. When instability no longer shocks, it no longer sustains the same premium in metals. Recognizing this shift is vital because it prevents us from overestimating the protective power of gold and silver at this stage of the cycle. The critical week that just passed reminded us that narratives tied to fear are fragile, and once they fade, capital will move decisively toward assets offering growth and returns. This fading of the geopolitical premium doesn't mean metals won't matter again in the future. They will regain importance when shocks are unexpected, when instability truly blindsides markets, or when trust in paper assets is deeply undermined. But for now, the diminished response reveals that the cycle has turned. Holding on to the old story is not a strategy. It is a liability. Markets are never just about fundamentals. They are about the stories we tell ourselves and each other. Prices move not only because of supply and demand, interest rates, or geopolitical shocks, but because of the collective narrative that investors believe in at any given moment. Narratives create conviction, and conviction creates flows. But once a narrative begins to crack, the shift in psychology can be swift, brutal, and self-reinforcing. That is what we are now seeing with gold and silver. For more than a decade, the prevailing story was clear. Precious metals were the ultimate hedge. They were the protection against central bank money printing, against fiscal irresponsibility, against systemic fragility, against geopolitical chaos. People didn't just buy metals because of their intrinsic properties. They bought them because they believed in the narrative that they were indispensable in a world gone mad. That belief itself kept demand strong, often independent of short-term fundamentals. But narratives are fragile. They thrive when the environment supports them, but they unravel quickly when reality stops cooperating. In the past week, we witnessed cracks in the story. Investors began questioning whether the reasons for owning gold and silver still outweigh the costs. With central banks tightening, real yields rising, and geopolitical risks failing to produce the expected rush to safety, the story lost some of its power. And when stories weaken, flows reverse. The psychology of markets is often underestimated. Once enough participants stop believing in an idea, selling starts. That selling in turn pressures prices. Lower prices send a signal that the narrative is failing, which triggers more selling. This is the essence of a cascade. It's not always about a single piece of news. It's about the feedback loop between belief, behavior, and price action. For gold and silver, the past week marked the beginning of that loop in motion. This dynamic explains why markets can shift so dramatically, even without massive changes in fundamentals. When the crowd loses conviction, the selling can feel disproportionate to the underlying drivers. But that's the nature of psychology-driven markets. They don't move in smooth, rational increments. They swing in waves of enthusiasm and despair, reinforced by human emotion. What makes this moment so important is that gold and silver are particularly vulnerable to narrative breakdowns. Unlike productive assets, they don't generate cash flows or dividends that can anchor their value. Their worth is largely a function of what people believe they are worth. When that collective belief is strong, metals can soar regardless of other conditions. But when the belief falters, there is nothing to fall back on. No yield, no income stream, only the shifting psychology of the market. Consider how quickly sentiment has shifted. Not long ago, the dominant story was that gold was headed much higher. As debt spiraled, currencies weakened, and global instability grew. That narrative was widely accepted and people piled in. Now, after the critical week that just passed, doubts are emerging. What if central banks succeed in stabilizing inflation? What if real yields keep rising? What if geopolitical risks remain contained? These questions erode conviction, and conviction is the glue that holds the metals trade together. Once conviction erodes, even long-term holders begin to reconsider. Some trim exposure, others exit entirely. The selling pressure builds, and suddenly the very asset that was supposed to provide safety feels unsafe. This reversal of psychology is what makes turning points so powerful. They don't just change price, they change behavior, which then changes price further. The lesson is clear. Narratives are not permanent. They are cycles, just like everything else in markets. They rise, they peak, and they decay. The narrative that gold and silver are the ultimate, unquestioned hedges is now in its decay phase. That doesn't mean metals won't recover or regain importance in the future. It simply means the story has lost momentum in the present, and when stories lose momentum, capital flows elsewhere. For investors, the takeaway is discipline. One cannot afford to cling to a fading narrative out of habit or emotion. The key is to observe psychology honestly, without bias, and recognize when the crowd is moving on. Because in markets, perception is reality in the short term, and the perception today is shifting away from metals toward assets offering yield, innovation, or growth. This is the danger of relying too heavily on stories. They can be powerful allies when they work in your favor, but they can become dangerous traps when they unravel. The critical week we just witnessed marked the beginning of such an unraveling for gold and silver. The crowd has started to question, and once that process begins, it rarely stops quickly. Recognizing this is not pessimism, it is realism. And realism is the foundation of good decision-making. The greatest mistake investors make is assuming that what worked yesterday will continue to work tomorrow. This assumption is natural. It provides comfort. It reduces the need for constant rethinking, and it rewards loyalty to familiar strategies. But the reality of markets is that conditions change, cycles turn, and what was once an advantage can quickly become a liability. The real edge comes not from clinging to old strategies, but from the adaptability to let them go when the environment demands it. That is the essence of survival in investing. Gold and silver provide a perfect case study For more than a decade, they served as reliable hedges against monetary expansion and political disorder. They rewarded those who accumulated them while central banks suppressed rates and fueled liquidity. But the environment has shifted. Policy is tightening, real yields are rising, and the geopolitical premium is fading. The narrative that once sustained metals is unraveling. In this environment, holding them with blind conviction is no longer prudent. Adaptability begins with acknowledging reality as it is, not as we wish it to be. Too often, investors become emotionally attached to an asset class or strategy. They confuse their prior success with a permanent truth. But markets don't operate on loyalty. They operate on incentives. Right now, the incentives are changing. Capital is being pulled toward assets that offer yield, innovation, or relative stability, while gold and silver face headwinds. Adapting to that reality means rebalancing, reducing exposure where the risks outweigh the rewards, and reallocating to areas with better asymmetry. This doesn't mean metals are worthless or that they should be abandoned forever. It means recognizing that their role is different in this phase of the cycle. Instead of being the cornerstone of protection, they may need to become a smaller insurance piece within a broader portfolio. Adaptability is not about making absolute judgments. It is about adjusting proportions to fit the environment. Just as a sailor trims the sails when the wind shifts, an investor must adjust allocations when the cycle changes direction. The danger of failing to adapt is clear. History is full of examples of investors who rode a winning strategy until it became a losing one, simply because they couldn't let go. They told themselves the story would come back, that the environment would revert, that patience was the only requirement. But waiting through the wrong part of the cycle can be ruinous. The drawdowns are not just financial, they erode confidence, cloud judgment, and reduce the ability to act decisively when new opportunities arise. Adaptability, by contrast, preserves optionality. By stepping back from assets facing headwinds and redeploying capital into assets with tailwinds, investors maintain their flexibility. They stay liquid, they stay engaged, and they stay aligned with the forces shaping the present. This doesn't eliminate risk, but it increases resilience. It allows one to navigate not just the current shift away from metals, but also whatever comes next. The broader lesson extends beyond gold and silver. Every asset class has its cycle. Bonds, equities, real estate, commodities, all of them move through periods of strength and weakness driven by policy, psychology, and global forces. The key is not to identify one permanent safe haven, but to cultivate the discipline to pivot between them as the tides change. That discipline is what separates those who preserve and grow wealth from those who are left behind. This is why the critical week that just passed is so important. It signaled that the environment for metals has changed. It marked the point where adaptability became more valuable than conviction. Those who recognize this shift will protect themselves and position for what comes next. Those who resist it, holding on to yesterday's narrative, risk being caught in a cycle that no longer favors them. The path forward is not about abandoning gold and silver forever. It is about redefining their place in a portfolio. They will matter again when conditions shift, when policy turns back toward easing, when trust in currencies erodes more severely, or when geopolitical shocks blindside markets. But until then, adaptability means reducing reliance on them and exploring other opportunities that reflect the realities of today. In the end, adaptability is the ultimate hedge. It is the ability to let go of what no longer serves you, to embrace what does, and to prepare for the inevitable changes ahead. That is how wealth is preserved across cycles. That is how one stays not only in the game but ahead of it. And that is the lesson of this moment. The time to adapt is now.